With the recent price drops of Realty Income, everybody in the market is wondering, is this company a long-term hold or should we sell it now? Watch this video to find out my opinions. What's going on, guys? Welcome back to another video. And today, guys, I kind of wanted to cover a highly coveted dividend distribution stock today. And as you guys may know from the intro, it's going to be Realty Income Company with the ticker symbol O. Now, as you guys may know, O recently released their quarterly earnings, and a lot of people are really worried about the numbers that they reported. I first want to start this video by saying I think Realty Income has a lot of potential in the future, and it's currently one of the highest yielding dividend stocks on the stock market. I'd like to first say, guys, that I think Realty Income has a lot of potential, and I think the most recent quarterly earnings doesn't really tell the whole story. First off, I'm going to start by showing you guys the graph here. As we can see, year to date, they're actually down 0.7%. And if we kind of expand this graph, we see their 1 year graph chart, they're only up 14.27%. And if we go even further back to the 5-year chart, they're actually down 24%. Now, obviously, when we look at this chart, we can tell that the biggest price drop came due to COVID-19, as did every other stock in the stock market. However, as most of those stocks recovered, Realty Income has kind of been lagging behind. And basically, guys, some background on Realty Income is that they're a REIT, which is a real estate income trust. So basically, the way they operate, and they're actually forced by law to pay 90% of their taxable income back to shareholders. So that's why they're such a high dividend yielding stock. Now, the main thing that has people a little spooked by Realty Income is actually their most recent earnings release. Specifically, the thing that has people so concerned about Realty Income is their AFFO per share, which is basically the way that real estate income trusts kind of do their EPS. So they don't operate like a normal stock. The AFFO includes stuff like depreciation and amortization, which kind of gives investors a better understanding of their numbers. In their most recent quarterly earnings, they had an AFFO of 1.05 per share, which is up from last year at this time, which was 1.02. The panic has mostly come because they actually missed their FFO earnings by 7 cents. So a lot of people point to that as to why their stock has declined so much in the past couple of weeks. So I'd like to point out, guys, the reason why everyone is so bearish on this current position is actually a lot of factors. The first one is their current tenants. So they actually have a large tenant base of Dollar General, Walgreens, and Dollar Tree. If we go right here to their client diversification, as when you see their top 20 clients, their largest clients include Dollar General, Walgreens, and Dollar Tree. And you guys might be wondering, well, what does that really have to do with it? So we've seen kind of Dollar General, Dollar Tree, and Walgreens suffer the past couple of months. Actually, especially the past year, they haven't done very well. As far as Dollar General, a lot of it can be attributed to consumers trying to spend more wisely. As you guys may know, stuff at Dollar General is really overpriced, at least in my opinion, when you compare it to most other superstores and grocery stores. The reason for Walgreens doing so poorly is a lot of the pharmaceutical industry is moving to like mailing you your subscriptions, so there's not necessarily a point of them having a physical location. Lastly, Dollar Tree, actually, they've seen a huge decline in their customer base, mostly because it's not really the Dollar Tree anymore. It's like $1.25 tree or $1.50 tree. Another one of the big issues with Realty Income is they have a lot of tenants that they're either behind or they're not really good for their lease payments. If we actually come here to the quarterly earnings, we can see that with their changes in occupancy. So as we can see, their properties available for lease on June 30th, 2024 was 185. They had 212 lease expirations, and they released 131 and released to new clients 59. So that currently leaves them with 196 properties available for lease at September 30th of 2024. Now, in saying that, contractual rent on their releases was $131 million compared to previously of $125 million. So their rental income is actually increasing. It's just the amount of open leases is increasing at the same time. The last major point that people point to in terms of why they're wanting to get rid of Realty Income, pretty much stagnant growth over the past year. So if we look at that year-to-date chart here, we can see earlier in the year they were trading at about $57, $58 around that area. During the summer, we see kind of a drawdown here to at their lowest, $51. Later on in the year, we can see their stock price reach back up to around $62, $63 a share. And now with this most recent quarterly earnings, they came all the way back down to 57.02. So one of the main draws for Realty Income is their high dividend, but on top of that, they also offer a nice bit of stock price appreciation too. So when you combine that asset appreciation with the dividend yield, I mean, some people have been getting close to 20% returns depending on when you get into Realty Income. Now that I've discussed all the negatives that are associated with Realty Income, I would kind of like to show you some of the positives that would maybe make you rethink on selling off your position or actually buying more into the position. So since the Federal Reserve has cut the short-term interest rates, we're seeing stuff like CDs and regular bonds decrease in their yield. I think right now CDs are sitting at about 4% to 4.1% interest. Now, of course, we all know that CDs are extremely safe. The only event your CD doesn't get paid out is if the bank fails, and that's pretty rare. In saying that, though, we saw the Silicon Bank fail. I don't believe we're in for any major bank runs in the future. Of course, when we're talking about Realty Income, it is a stock, so there is more risk than there would normally be with a traditional CD or treasury bond. However, when looking at this one-year chart, we see that 14.27% increase. That combined with the dividend yield is around 19%. So depending on when you entered your position, you could be sitting fairly well right now. And as I mentioned earlier, guys, with Realty Income, there's always a chance for stock price appreciation on top of your dividend yield. If we go back to this 5-year chart here, we've seen where Realty Income has reached $80 per share. So if the stock reached back up to its $80 per share value, you would be netting close to a 40% return. And if we go back even further to this 10-year chart, we can see that they're still up 25% over the past 10 years. Now, the bad thing in looking at this chart is typically the S&P 500 returns 8% yearly on your investment, where Realty Income has only netted you 25% over a 10-year term. Now, my next point here is probably one of the most important things about Realty Income. If you believe in the long-term stability of Realty Income, which I believe most investors do at this current point, they offer a 5-year dividend growth rate of around 3.55%. And as we know, Realty Income has had 26 years of consecutive yearly dividend income increases. So even right here, we have this 3-year growth rate of 4.51%, 5-year growth rate of 3.55, and 10-year growth rate of 3.93. So if we go back on this dividend history chart right here, we can go back 10 years and see that Realty Income was paying 18 cents per share, and as opposed to now, they're paying around 26 cents per share. And if we go down here and see the price and dividend history, we can see that even whenever the stock price suffers, they still keep fairly solid dividends. I mean, right here we have $2.71 yearly dividends, $2.77 even whenever the stock price had decreased. I believe the yearly estimate this year is going to be, so yes, this year it's estimated to be $3.13. So Realty Income obviously proves to still be a solid company as far as dividend payments, even whenever the company's suffering as a whole. Back during COVID, we still saw that they were able to keep their dividend distribution the same and actually even increase it after COVID. And right here, they actually have a beta of 1. So, I mean, whatever the market does, the stock's going to do pretty much the same thing. And even if we look out at like a macro level, we can see that other REITs are kind of doing the same thing. Like VICI Properties has also returned 11% in the past year, and Realty Income has actually returned 14%. Same thing here with WP Carey Inc. They're also kind of suffering in the 1-year mark, and actually year to date they're down 14%. And year to date for VICI Properties, they're actually down 2%. Kind of in the short term, these REITs are trending sideways, which is okay currently. I think in the future, if long-term interest rates kind of settle down, then the chance for expansion is a possibility. Looking at Realty Income, though, I would kind of like to see more of those empty leases get filled before they try to expand. So if we look at the 2023 quarter 3 earnings, they have 159 properties available for lease. If we compare that with this year's earnings release, they have about 40 more properties that have yet to be filled. So looking into the future, guys, I'm definitely not going to sell out of my position of Realty Income. However, if the price continues to decline, I could see myself possibly adding some more shares. I believe long term in my personal use case, it's going to be fairly stable and still provide a pretty solid dividend yield in the long run. In my opinion, the main thing that would make Realty Income a definite buy is if they start to leverage down on their worst clients. I hate to use the word worse, but they're clients that aren't doing so well. So something like Dollar General, if they got that down closer to a 1%, Walgreens similarly, and then started upping stuff that's doing better, like their Wynn Resorts or FedEx, or even just their industrial warehouse space. In the future, I look for industrials to do fairly well, so I think that could be a possible replacement for stuff like Dollar General, Walgreens, and Dollar Tree. So let me know what you guys think about Realty Income. What are you guys going to do with it? Are you going to dollar cost average and add a little bit more of it to your position, or are you guys completely selling off? If you guys enjoyed the video, make sure to like and subscribe, and let me know what you want to see in the next one. 96% of you aren't subscribed, so let's add to that subscriber total. That's going to do it for this video, guys. I'll see you in the next one.